Welcome back to Debt-Free Dreams, your ultimate resource for mastering crypto, building wealth, and staying financially secure. If you're interested in cryptocurrency, you've probably heard the term crypto whales, but what exactly are they? More importantly, how do they influence the market? And what can you do to protect your investments and capitalize on their moves? In this video, we'll break down everything you need to know about crypto whales, their impact on the market, and how to track their activity effectively using some of the most advanced tools out there. Whether you're a beginner or a seasoned investor, understanding whale behavior can give you the edge you need in this volatile market. Stick around because I'll also share actionable tips and the tools you need to stay ahead of these big players. Check the description below for links to helpful tools. Part 1. What are crypto whales? Let's start with the basics. Crypto whales are individuals, institutions, or entities that hold an extremely large amount of a specific cryptocurrency. For example, someone who owns 1,000 Bitcoin or more is considered a Bitcoin whale. Whales can also exist in other cryptos like Ethereum, Solana, or any altcoin. Whales often include early adopters, investors who got into Bitcoin or other cryptos in the early days when prices were low, institutional investors, hedge funds, venture capitalists, or large companies like Tesla, crypto exchanges, platforms like Binance or Coinbase, which hold large reserves to maintain liquidity. The significance of whales lies in their ability to manipulate the market. A single large buy or sell order can create panic, excitement, or even a full-blown market rally. Part 2. How do crypto whales impact the market? Crypto whales have a profound effect on market movements, and here's how. 1. Market manipulation. Whales can artificially manipulate the market. For example, a whale might sell a large amount of cryptocurrency, causing the price to drop. They then buy back at a lower price, profiting from the panic they created. 2. Liquidity reduction. When whales move their funds off exchanges to private wallets, they reduce the available liquidity. This makes it easier for prices to spike with smaller trades. 3. Psychological influence. Whale movements are closely tracked by traders. Large transactions can trigger fear of missing out or panic selling, leading to rapid market swings. By understanding these behaviors, you can learn to spot opportunities and avoid falling victim to market manipulation. Part 3. Tools to track crypto whales. To stay ahead of whales, you need the right tools. Here are some of the best ones. Glassnode. Glassnode provides deep on-chain analytics, including tracking large wallet movements, exchange flows, and market sentiment. Use it to identify whale buy, sell patterns and make smarter trading decisions. TradingView. TradingView is a powerful charting platform that integrates with various data sources to help you spot market trends triggered by whales. Its customizable alerts make it perfect for staying on top of whale activity. CoinStats. With CoinStats, you can link your wallets and exchanges to monitor your portfolio and track whale-dominated cryptos. Its real-time alerts keep you informed of major price swings. 3. Automate your trades with 3. Set up smart bots to execute trades based on market conditions influenced by whale activity. This tool is invaluable for reducing emotional trading. Ellipal and Safepool wallets. While tracking whale activity is crucial, securing your crypto assets is just as important. Hardware wallets like Ellipal and Safepool protect your holdings from potential hacks. Part 4. Managing taxes and compliance. If you're serious about crypto trading, staying compliant with taxes is non-negotiable. Fortunately, tools like Coinly and Zenledger make it simple. Coinly automatically calculates your tax liability while offering insights into your portfolio's performance. Zenledger provides a user-friendly platform to track your trades, calculate gains, and prepare tax forms seamlessly. These platforms are lifesavers for active traders who deal with multiple exchanges and wallets. Part 5. For pro tips to stay ahead of crypto whales. Here are some practical steps to protect yourself and thrive in a market dominated by whales. 1. Follow whale wallets. Monitor blockchain data for large transactions. This is where tools like Glassnode shine. 2. Use stop-loss orders. On exchanges like Bybit, set stop-loss orders to protect your investments from sudden market drops caused by whale sell-offs. 3. Diversify your portfolio. Don't put all your eggs in one basket. Tools like CoinStats can help you manage a diversified portfolio with ease. 4. Stay emotionally detached. Whale activity can trigger emotional responses. Stick to your strategy and use tools like 3 commas to automate decisions. Crypto whales may seem intimidating, but with the right knowledge and tools, you can turn their market movements into profitable opportunities. Don't forget to explore the links in the description for tools like Glassnode, TradingView, CoinStats, and more. They're game changers for crypto enthusiasts at any level. If you found this video valuable, make sure to smash that like button, subscribe to Debt Free Dreams, and hit the notification bell to stay updated on future content.